Welcome back to Almost Nowhere, the podcast where we explore what's next for insurance and how to get there from here. I'm Alicia Burke, Director of Portfolio and Product Development at ICAS, and I'm joined by my co-host, Max Martinelli, Lead Actuarial Data Scientist at Accurate. Today, we're joined by Jonathan Lim, a CAS Fellow and Head of Underwriting at Re. He spent his career balancing the transformation of reinsurance, capital management, and emerging tech. We're digging into whether insurance will lead or lag on tech adoption and what actually matters for the future of risk. Jonathan, thanks so much for joining us here today.
Thank you for having me.
So I guess we'll get the audience introduced to you first. Can you tell us just a little bit about your journey from reinsurance and capital modeling to underwriting leadership at Re?
Sure. I've spent nearly 14 years in the world of reinsurance. A lot of my early days were with the reinsurance broker on the analytics side of the business, building a marketplace for buyers and sellers to trade. And so a lot of my time was spent crafting arguments around cost of capital, why it made sense from a balance sheet perspective, how you make your metrics look better for investors. And then I went to an insurtech to help them design their balance sheet, growing insurtech, that wanted to establish themselves from an MGA to a carrier, and then continue to grow, their book and making sure that they had sufficient capital for that. So there was a lot of helping them understand how to navigate the rating agency process and how to think through what capital regimes or operating structures made sense. Now I'm on the side of the table that sells reinsurance. Now I look at MGAs, insurance companies. I look at books of business, understand their profitability, and try to find solutions for them, whether it's for risk transfer or capital management perspective.
Maybe just, a general overview of what's going on in reinsurance right now might be helpful for the audience. I talk to a lot of carriers, and I wouldn't say they're exactly pleased with their reinsurance companies right now. But, I also feel like from the reinsurer's perspective, they're kind of playing this force to upskill maybe the carriers, if that's the way to put it. But at the same time, there are carriers who are starting to take more risk on themselves. There's always the cat bond market. Can you just give us like the 30,000 foot overview of what's going on in reinsurance?
Sure. That it's always an interesting experience working behind a layer of insurance companies. Broadly, we see a lot of the same cyclical forces of demand and supply. Demand for reinsurance is always going to come from insurance companies just wanting to manage their volatility. Your management has a lot of incentive to deliver stable returns to their investors. So when you think about reinsurance, a lot of folks associate that with XOLs, which are excess of loss contracts that fit the amount of loss on any one event to a specific threshold. The reinsurers are taking all the excess exposure from any event. And the challenge there, of course, is some of these excess of loss, divisions of loss between what's the insurance company going to pay and what's the reinsurance company going to pay. That hasn't really changed in a long time. So when you think about dollar values of exposures have grown, right? That's just inflation, and books have grown. And there are forces, insurance level, where a lot of folks talk about social inflation, litigation finance, increasing costs of insuring natural catastrophes. There's a lot of pressure, loss costs at the primary level that make these divisions of who's going to pay for what between the insurer and the reinsurer kind of unsustainable. So of course, naturally, reinsurers are essentially going to say, well, if I provide you the same level of coverage, it's going to be more expensive. So the insurance company essentially has a trade-off, right? They can choose to retain more themselves, potentially pay less, or decide they want the same level of coverage and pay more. Similar dynamic between the insurance company and the customers they serve, right? I think a lot of folks may not understand how deductibles work until they have a claim, and that's when they realize, hold on a second, what's my insurance company doing to me? Why aren't they paying the full claim? So I think it's crucial there, but it does lead to, as you mentioned, a bit of a upskill where reinsurers really want insurance companies to take ownership of making more informed underwriting choices, making more informed risk management decisions, because the outcome is great for everyone. It benefits the insurance company, it benefits the reinsurance company, it keeps that partnership going. So high level, there's still a lot of that going on. There's still a lot of, I'll say, dislocation of the equilibrium between buyer and seller. Seems to be coming down a bit for property, but there's still a bit of a struggle in the casualty markets.
I have a question on the topic of tech adoption in the insurance industry. They may have a reputation that they're a little bit slow on tech compared to other financial sectors. Do you agree with that or disagree?
I would agree with that. And I don't necessarily blame any specific groups within the insurance industry for that being characteristic of the overall industry. I do think some of it is just an unfortunate consequence of the path we took to get to where we are today. And so one example is some of us might remember Y2K. That was the big scary event that as soon as you hit the year 2000, all your computer systems would just cease to function. I think insurance companies looked at that event and said, let's hold on to a lot of the legacy systems that we have. Let's not make any hasty decisions in replacing mainframes or giant databases or systems of operation that they had in place. And some of that has led to an accrual. I think some folks call it technological debt, where in order to decide whether they want to implement a new type of technology, you have to go back and figure out how to reverse decades of, I think this is a bit of an exaggeration, but I saw something when somebody said, I still have a mainframe. I still have to put in a punch card in order for this technology to work, in order for me to be able to service my policies. And I think that is really unfortunate, but is sort of why I think change sometimes can only happen outside these large established insurance companies, which leads to formation of insurtechs and focus MGAs that they don't have that burden. They don't have the decades of baggage. They can jump into a marketplace, build something from scratch, and say, here's something we can do, and we can do it well. I think there is that unfortunate consequence. But that being said, not a lack of motivation, because I do think insurance companies recognize the need, depending on what technology we're looking at. There's a point in time where, yes, it's an advantage. If you do it, you have a slight edge over your competitors. And if you wait too long, it becomes a disadvantage if you don't do it. Everybody else is doing it, but you're not, right? So there's that tipping point, and insurance companies definitely consider that competitive dynamic.
Do you think with Gen AI, they'll be able to jump forward on technology faster?
The challenge with any discussion internally around decision-making around whether or not we want to conduct a proof of concept or implement Gen AI on any insurance workflow inevitably goes back to data. And the challenge with data in any insurance company, like anybody that has worked in an insurance company can attest, is it's almost always siloed. Whether it's because the insurance company itself is made up of just an acquisition of other entities, and so they all have their own systems and data structures that don't necessarily integrate well, or if it's because functionally within the insurance company, payments is using one data system, underwriting is using another one, policy admin's using a different one, claims is using another one. To get them to all line up and talk, the sense is that Gen AI is going to come back to some painful discussions about how do we have data, a central location, so that you've got this really powerful engine, essentially a layer of interpretation that anybody can interact with the data. I don't just mean, the folks that are used to interacting with the data, like the data scientists or the actuaries. I'm talking about senior management, underwriters, the lawyers, right? Folks that don't usually want to write SQL queries. They can now interact with that level of data, and they can then decide, how that data can help drive their workflow in a more efficient manner. I think that's going to have to be overcome first, that data centralization. And that's the challenging piece. That question has not really, in my opinion, been answered really efficiently, even before AI came along. So I hope is that with AI now in the background, thing that can really turbocharge a lot of insurance companies' operating efficiency. I hope is that becomes addressed and becomes a priority.
I mean, even from my end, being at a vendor, right, I think we're seeing something interesting right now where the sales cycle has really compressed since when I first started like 2.5 years ago. And so you might say, well, yeah, the company is more mature and it's more well known, so that's normal. Like when we're going up head to head with competitors, it's kind of the same thing. So like people are making decisions faster. There's a little bit more of a sense of urgency. But yeah, data is in the input to everything, right? And we hear that in virtually every deal. Like we're in some sort of data transition strategy. Where they are in that journey really dictates the speed at which they can move. I also feel like I've been hearing this my whole career, though. So I wonder, is it just a mission critical point recently, or is it that the ROI has finally changed with some of these developments? Or is it just things are starting to break? Do you have any pulse from what you're seeing?
I think it's organizational momentum finally paying off, right? You've had conversations from over a decade ago about, it's before LLMs, right? The topic for the longest time was how do we take these more advanced pricing models that are not just two-way grids? How do you take that and create a competitive advantage because there's nobody else in the market's doing it, or you can do it slightly better than your competitors? And in order to do that, you needed to have the data to run through the model, right? If folks were thinking about how do you create yourself a competitive moat, 10 years ago, and they're saying, well, step one, the data in a good, clean spot. 10 years later, we're now seeing the benefits, the major movement, the momentum that it took to overcome. And as a result, I think a lot of folks now actually have good data to work with, or at least in a much better position than they were. Have this momentum that compounds, and now you have new technology in the form of LLMs that allow insurance companies to take advantage of the fact that they've already done a whole lot of groundwork to get their data in a good spot, and they can leverage other technology, right, for that data. So I think there's definitely been movement. Of course, it varies from the size of the organization, age of the organization, but overall, to your point, I have anecdotally seen companies in a much better position to report data that's actually good and accurate, and two, in a timely manner. Insurance, like all other financial services, just there's so much data, right? Data is one of those things in insurance companies that we'll say regulations are written in blood, right? But data is written in loss ratios. You have data, you have actual useful data to action, price, and underwrite on. That comes from paying a claim that nobody else paid, that you paid, right? And so insurance companies are so careful to safeguard that, and they don't want to share that because that represents their competitive advantage. The challenge is, how do you unlock the value in that? How do you get the data in a good spot where you can then run useful models on it, or large language models on it to give you that kind of value add for the entire organization rather than just a small group of actuaries or data scientists?
I mean, yeah, I love that quote. Data is written in loss ratios. I wish I knew that 2 years ago. But yeah, great quote.
So we've mentioned Gen AI, there's telematics, there's drones, there's decentralized finance. What are your thoughts on what's actually most relevant for insurers and reinsurers?
That's such a great question, because I think a lot of the tech that we are seeing today, if you look at the momentum of how that tech has developed, it's really centered around what I would consider generating new data or squeezing more value out of the data that already exists, right? And I'm really excited about tech that generates new data, right? Because that's information that, if you look at the insurance industry, everyone's trying to find an edge. How do I draw a better ring fence around my customers so I can pick out the better risks? How do I charge my customers accurately and commensurate to their risks so that I don't get adversely selected against? Theory, at least, is that the more data you have that at least can be tied to actual claim outcomes or loss outcomes, better your position is from a competitive standpoint in the marketplace, right? So take, for example, satellite imagery, right? Or drone technology. There are startups out there now that allow you to capture roof conditions. If you were writing property insurance, you might not want to do this, but you would have the option of looking at the property condition based solely on the satellite imagery. You'd have a good sense for the roof condition based off drone images. Fairly high resolution. In some cases, the software vendor can even run their own classification or detection models on the image to tell you. So you don't actually have to look at the image as the underwriter. It will just tell you this roof has a score of 1 to 10, like how good it is, right? So their technology, I think, gives insurance companies just the additional data that didn't used to exist. In theory, that should provide an edge, right? Of course, the question is, how do you use that data to either give yourself that edge, or in some cases, if you don't use it well, it eventually leads you back to where you started, which is you needed more data to begin with. It's technology that I find fascinating, also in the realm of generating new data, which is around claim prevention. How do you make yourself a better risk, right? And telematics is a good example. You see that a lot with, the likes of Progressive. I think that's potentially where, the severities are higher and the stakes are higher. And so those devices tend to have a bigger impact. That's really, in my view, where the insurance industry really should be headed, right? We I'm thinking of it as a social utility now. In industry, we put a price on all of this business activity that happens in the economy. We essentially give business operators or consumers a signal that says, your activity is productive and this level of productive, or really not productive to the rest of society, because you continue operating your business in that way, you're going to represent a large economic loss. It's a drain on the pool of funds available. that price signal is a starting point, but what I really would love to see in the future, and I know a lot of folks are already doing this, is giving incentives to the customer to help them control their loss, to the extent that it reduces their risk in real time, to the extent that it helps them become safer operation. In some cases, it might even save their lives. That to me is what's really fascinating about technology like that, a real-time view of your risk, right? I think of it in a future science fiction where, maybe you have a watch that tells you, hey, you want to go snowboarding today? That's not a good idea. It's going to cut your lifespan off by 5 years on average. You can still decide to go snowboarding. That's your prerogative, but you have the information now. You can make that decision, right? You look at insurance, you talk to your agent once a year. At the end of that year, you find out they're going to charge you 20% more. You're outraged. A lot of that, there's reasons for that. And I think if people understand that a lot of this is driven by risk and what's happening with the economy at large, that helps, right? The goal of any insurance company at the end of the day is really put their customers in a better position, both before loss, really before loss, but even after a loss, right? So technology that helps in that regard to me is fascinating.
Would you write a carrier that doesn't collect roof condition? Because I'm actually surprised, coming from a very large carrier that's been in the rating plans for over a decade, but coming to Accurate, you work with small mutuals who are just trying to balance the cost of everything, and some have it, some don't, but it feels like there's some pressure from the reinsurers to really start collecting those roof variables. Like, do you guys underwrite against the carriers that you work with? Do you have like rating plans for the carriers that you kind of like step through and put multiples on?
So there's a bit of push and pull, right? I think if you're going to write a policy that has placement costs versus actual cash value, right at the outset, it's a legal contract that says your amount that you have to pay is a lot less, then the stakes for you to get it right are a lot lower, right? And so when I think of the smaller mutuals, I think in order to stay competitive, they don't need to have all the bells and whistles that you might find at a larger carrier that has more money to invest. The cost of that is going to be selling a policy that is not as necessarily protective, right, of the customer. And that's a bit of the trade-off. I don't know that consumers understand that level of intricacy when they buy insurance policies. I tend to think the average consumer treats insurance like a commodity. And I think that's unfortunate, right? If you just say all insurance policies are the same, I just want to get the cheapest policy, then inevitably you get a spectrum of product offerings where at the bottom end, you may not be buying a policy that covers you when you want it to cover you, but it costs less because they're not sending drones out to check your roof. Firstly, on the other side, you might have to pay more, but when you need it the most, that's when it matters. And the policy that will actually pay a claim based on the characteristics that you've represented or drone images or whatnot. I don't view that as a premium product, though it could be interpreted that way. But that to me is the more useful product, right? And I'm unfortunate because, to your point, a lot of these smaller mutuals, they just don't have the ability financially to conduct some of these pilots or invest in some of the technology. And so one of the things when you look at technology adoption in the insurance industry is going to see all these small, nimble, agile, MGA tech forward entities spring up and a lot of good work. And then they'll work with the different carriers that like the work that they do. And eventually they'll get bought out. It's the mutuals that really can't compete, right? Because they either have to go buy an MGA or they have to figure out how to do the tech themselves. And that's tough. So it'll be interesting to see how that shapes up.
Yeah, definitely. I mean, yeah, it's definitely top of mind and very present in a lot of the conversations I have. But they are nimble, and maybe scrappy is not the right word, but they find a way to differentiate themselves. It's almost violates what we learned about like adverse selection, but they can compete on this differentiation. So it's kind of interesting to see how that plays out.
So we talked a bit about the useful tech. Curious, Jonathan, if there's anything you think is overhyped.
That is challenging to understand can always initially seem like it's overhyped, right? Especially because there's going to be, at least when it first starts out, there's going to be an echo chamber of true believers. I'll use Bitcoin as an example. I suspect some people might not like that. For the longest time, there were real true believers of Bitcoin that said this is supposed to replace money of the world, and all of you just don't see it. You don't understand it. I think it's opened up a whole ecosystem of other alternatives to Bitcoin that actually could be used as payment systems of the future, and I think we're already seeing some of that in the former stablecoins. But in terms of tech today that's overhyped, in general, as long as technology is developed in the direction of the benefit of the customer, to me, that's always technology worth pursuing, right? There's always going to be questions about what's the cost and what's the economical impact of putting that technology into operation. And those are questions for carriers to figure out. But autonomous vehicles are a huge discussion point. I think even when I was about to enter the industry 15 years ago, people were asking, who's going to pay insurance premiums if you have a car that drives itself? And 15 years later, people are still asking that question. That tells me that that's still a good problem to solve if you're about to enter the industry and want to think about that. But that also tells me that a lot of the technology that we think about as potentially being overhyped and then subsequently taking a long time to get to market, that actually tells you that there is behind the scenes forces that are trying to make that more relevant, right? Why don't we have full level 5 autonomous vehicles today? The fact that data shows it's a lot safer. Turns out there's still a lot of software needs to be figured out. But there are a lot of questions around there, and I'm hopeful that will a lot of these technologies will materialize sooner than later. And when I look at autonomous vehicles, I'm also really excited because it's the folks that generally cause the most accidents that are more likely going to adopt those first. Need everybody in society to have a driverless car? No. But if it's the generally older or younger population that starts to adopt that technology, then everybody's well off. I don't think anything's overhyped in my opinion. I'd be curious to hear if you folks think on your end.
I mean, yeah, to me, it's very much in line with what you said, right? I think a lot of these things will materialize, but it's more of a cost thing. And just even going back to telematics, I've seen a bunch of carriers kind of abandon telematics, not because they don't believe in it. It tends to be, the best marginal variables we've added in a long time, but it's just so expensive to secure the data, wrangle it, build these models, refresh it. And it's like, it's unlike anything that we've ever seen in terms of the volume of data. So it's just really hard to administer. And we've already talked about how challenging data can be. So if you're in this, begrudging data transition strategy and you're layering this on top, it's just not viable. So it's really a cost thing. And maybe eventually that will come down. I tend to agree with everything that you said.
It becomes a matter of how expensive is it and how much energy it's going to take. But the underlying value, I think, is still seems legit to me for now.
Self-driving cars is an interesting one, though, because that one has just had a very interesting development over time where, 10 years ago, we were saying it was inevitable. 3 to 4 years ago, they were saying we'll never get past L2.5, L3. And then more recently, we're like, oh, wait, we're past L3. Like it's just all over the place. And it feels like kind of the ground floor research, that we're seeing with places like Waymo isn't quite making it to the mainstream. So I'm curious if even the narratives that we hear bubbling at the top are really representative of where the technology is at.
All I can say in that arena is every time I have folks come out to San Francisco and we take a Waymo, so impressed. And 9.9 out of 10 times you get out of the car and say, well, I felt as unsafe as being in an Uber. So I think that's a sufficient endorsement, right? And what I like to remind myself is the level of technology that you see today is only going to get better. Singling out Waymo as an example. But if you look at where Waymo is today, I think they've got 70 million miles under their belt, right? They get to 100 million miles and they can make that data in terms of their average accident and fatality rate relative to national highway transportation safety benchmarks. It's going to be a lot more apparent. For the consumer, it's really just going to boil down to cost, right? Cost of owning a vehicle, paying the insurance on it. The economics make sense. The average consumer is not going to have a philosophical opposition to, I need a human in the driver's seat before I'll get into a vehicle. But you know what? You can actually work, text, listen to a podcast instead of having to pay attention to the road. There's a lot of benefits.
Let's shift a bit to decentralized finance. So can we just start with a 60-second demystifier for our listeners on what it is, why should insurers care?
Absolutely. And it falls back to the theme of data because insurance is one of the more data-rich verticals of the economy. So you've got a lot of this data sitting kept for anyone in public to ask, particular insurance companies accident rate that they actually see or it's their average severity and frequency. That level of information is usually difficult to obtain, outright impossible. So having to depend on a lot of what you believe the insurance company represents in terms of their data, right? That notion of having to trust somebody else to tell you what the data is, I think foundation of why something like decentralized finance is so powerful. So let's take a step back and talk about what it is and what it represents. Decentralized finance essentially is a collection of applications built on top of a peer technology that allows for decentralization of data verification and data security. So let's start at the bottom, that level of data. It's usually represented by what folks call the blockchain. So if you think about data, right, let's use the three of us as an example. Let's say the three of us agree that we're going to start a pool of money. Sometimes Max is going to pay me, sometimes I'm going to pay Alicia, and we're all going to pay each other. But other than actually trade actual dollars, we're just going to record it on a ledger and we'll settle at the end of the day, right? And the rule is that we'll just tally up all the pluses and minuses, and I owe the pool $10. I just put $10 into the pool. Alicia, maybe you net $40 at the end of the day, so you take $40 out. That level of ledger and transactions is a very simple representation of how we can essentially trade dollars. Now, let's just say we don't want any one of us to control the ledger, right? I don't know if I trust Max to record my transactions. I don't know if I trust Alicia. I just met the both of you. We all agree that there's the way that we can design a mechanism so that we don't have to have trust. We essentially use the power of mathematical cryptography. And so that happens in two ways. So one, anybody can add to the ledger, but they can only do so if they have a digital signature, essentially a way to verify that you represent the assets that you say you have, and it's you who's actually authorizing the transfer. And if we did that, then if I see, Alicia paid Max $10 and it's signed, and I can verify that signature if you're familiar with public-private key cryptography. And it's very easy to represent that, yes, that's a valid transaction. But anybody who does not have your signature, Alicia, they can't say that you paid Max $10. So that's the first layer of security. The next layer of security is then to determine, so how do we all make sure we have the right transactions? And that is just going to be sourced to a separate group of people who, every time we make a payment, we're going to tell them, hey, I paid Alicia $10. Separate group of people, they're now going to take all of these transactions, they're going to put it on a block. So they're just categorizing a series of transactions. And then they're going to solve a puzzle. Actually, they're going to find a special number that satisfies certain conditions. And mathematically, this number, the only way to solve it is to keep trying a different number until you find it. What that does is whoever finds the number first will then say, hey, I found the number, so therefore I have secured this block of transactions. I know that this is a valid block of transactions. That block of transactions will now live in the ledger as valid set of data, that the only way to continue building off that block is to always find that special number first on any subsequent block. It ensures then that anytime you say you've paid somebody $10 or I say I'm paying somebody any money, as long as there's always people out there trying to solve this puzzle, as long as we always confirm that the number that they have found is valid, we can ensure that one, this method of tracking who's paying who is actually secure. There is consensus essentially, because Max's ledger and your ledger, Alicia, and my ledger, they're going to look the same. There's some mathematical proof behind all of this that allows all of this to happen. And so let's zoom back out, right? You've got this layer of data collection and security that is represented by the blockchain. What that allows anybody to do on top of that is, if you need to represent any kind of data, right? In this case, I use transaction data or ledger. You do not need to rely on a third party to tell you whether that data is correct. You do not need to rely on anybody else to tell you what's in the data. Anybody can go and look and see for themselves and verify for themselves. Right? So I don't have to trust the bank to tell me that Max is $1 million. I can actually just go look at his wallet and confirm that. And I can have a great deal of security that is verifiable and accurate information. But DeFi sits on top of this layer of data that adds what I would consider a vending machine, right? So if you want to buy something, go to a store, you tell the store owner, give me a can of Coke, you get your can of Coke, pay them, you check the change is correct. But if you go to a vending machine, you don't have to do all that thinking around that transaction. You just press the thing you want, you put in whatever money you have, and whatever you get out, is correct because it's programmatic. So I think of DeFi in the similar sense, where it's this entire world of programmatic applications that sits on top of this layer of data that allows you to replicate a lot of the financial services that you see in the real world. So you can do lending, which if you think about it in the world of DeFi, allows me to lend Max money without having an intermediary. So if Max is to collateralize, all of that can be done in a smart contract, looking at the value of his assets every day and ensuring that it's topped up. I can get my money back as soon as some certain conditions are met, whether it's time or other based on his assets. And so this level of what I would call decentralization allows anybody in the world to participate in financial services, banking, lending. Inside the US, we're talking about a large market that either cannot access these traditional financial services or live in a country where they have very volatile currency, which makes it challenging to access banking. One really good example of all of this is, I mentioned earlier, payment systems, right? So we have what we call stablecoins, which are essentially digital representations of actual fiat currency. So a lot of the stablecoins today are denominated in US dollars. So one of these tokens represents a US dollar, and they're backed by fiat reserves. So it's just money sitting in an account that guarantees the value of that digital token. Today, if you wanted to transfer money from the US to anywhere in the world, you'd have to go through the SWIFT architecture, which can take days. And it does involve a lot of bank fees. That level of what I call operational friction is usually prohibitive for a lot of people trying to send small amounts of money. With stablecoins, essentially you can send money from any wallet here to anywhere in the world in seconds, or a very minute fraction of the fees it takes. Right? So there is both a speed and a cost massive gain in efficiency there that makes it almost impossible not to say this is going to be the payment system of the future, right? So that's just one example of how DeFi really opens up access to the financial services for anyone. As long as you have an internet connection, can participate in this trading.
So a million follow-up questions, but maybe we'll take it one step at a time. So maybe just to play devil's advocate for a moment, right? I think most people know the story. There's kind of a libertarian slant to the origin of Bitcoin, and the idea is that we need a decentralized ledger because kind of government monopolies on fiat, and then the alternative with like gold, it's just so hyper financialized. We need something independent. And I think anyone who sent a wire on a Friday, they know what you're talking about with the value of the stable coins. My thought is this really even as decentralized as we say, though? Because we've kind of seen like the exchanges, or like this, it's like proof of stake in Ethereum is kind of like a version of centralization, in my opinion. The stable coins are operated by companies. I wonder, like, are we really moving to a less decentralized environment with this?
So you mentioned proof of stake, but I think your question more broadly has to do more with governance, right? So I want to draw the distinction. When we say decentralization, we're talking about the layer of technology that governs how data is verified and tracked. Right? Because earlier in my example, I said I don't have to actively listen out to whether Max is paying Alicia, or nobody has to listen to who's paying me. All we have to trust is that there's a group of essentially miners, because I'm using Bitcoin as the example now, but there's a group of miners incentivized to solve this mathematical puzzle in order to ensure that this ledger is going to continue to be accurate, right? And there is consensus in our ledgers, right? So that's the decentralization I'm talking about. We don't have to rely on a bank to track that information. We don't have to rely on a government or some central authority to figure that out. The governance aspect of these protocols you mentioned, right? You talk about Ethereum being proof of stake. Proof of stake just an alternative to how Bitcoin operates using what in my example earlier I said there's a separate group of people called miners, and so that work of verifying the data on chain is called proof of work, right? Essentially, the work they're doing is solving this mathematical puzzle to ensure that the data is accurate. Now, it's a lot of money. There's a lot of electricity and computing power involved. And so that was always a criticism. And that's why Ethereum actually moved to a proof of stake, where instead of using computing power to solve a problem, you're using your own financial position, right? So they're asking folks to put up their own assets in order to verify that the data is accurate. Well, that's actually done. That's debatable, right? Does that necessarily increase or decrease centralization is a function of the design of the system. It can go in either way. That can be changed, right? Just because it's an open system, it's all it's open source and everything. A lot of the community actually does have a say in the direction of how Ethereum's developed, right? Keep in mind, Bitcoin was developed more like what I would call digital gold. Ethereum was more developed as a world's computer, is kind of how I think about it, because Ethereum is the platform that allows you to have these smart contracts, which are programmable. This is a technology that can control your assets move, right? But talk about decentralization, and I think what it comes back to ultimately is this notion that you just don't have to rely on any one individual or any powerful group to tell you what the data is or whether the data is accurate or not. The technology itself lets you do that, right? So any actuary that's ever worked in any actuarial position, I'm sure has always come across, so what's the actual source of truth? You've given me a bordereau of policies and claims. How do I know? I need to check control totals. I need to check, did the data get muddled up somewhere, right? A lot of the work that goes into just verifying the data is correct is just painful operational work. So when I talk about decentralization, that's really the benefit here, is that you don't have to trust what anybody says. Ledger itself is proof of the fact that the data is accurate, right? So at the end of it, what really matters is the technology itself is designed in a way to ensure that the data doesn't have to be verified and authorized by any one central party.
The classic counterexample I think people would come up with is like, Visa or MasterCard. These are centralized ledgers that aren't public, but they do like a great job maintaining them. They're really efficient. Now they take a cut for sure, right? There's a cost, but like the volume that it can take on is just immense, right? So like, what would be the claim of like, is this just an alternative out there? So it's like you can do either or. Like, do you really see like a fundamental issue with like just centralized ledgers in principle?
I think the answer, just proof, is in the empirical adoption of stablecoin technology by. I know Visa's looking at it. There's already Amazon's looking at it. Mart's looking at it. They're not looking at this technology necessarily as saying we like the idea of decentralized data and we're true believers in what this means for the world of finance. They're looking at it purely from an economic point of view, right? This is so much cheaper. This is so much faster. And it doesn't have the challenges that Bitcoin has, which, one, Bitcoin's not programmable, because Bitcoin was the technology around Bitcoin was never built to be more than just a store of value. Stablecoins, you actually can program money to do certain things based on certain conditions. The fact that these large companies are already looking for ways to take advantage of this technology, I think, tells us a few things, right? Like, one, that the decentralized technology itself is value, right? The value is in being cheaper and faster and the payment systems that we have today. Now, is Visa going to develop their own open source decentralized stablecoin? Probably not. I think what they want to do is use it as a back-end system that enables them to transfer money throughout the world. So I think it's going to be an interesting point in time where we have a lot of the developments in DeFi have taken place to date without a lot of concrete regulation around how stablecoins will be treated in the marketplace. And there's evidence now that we have some of that. Now that we have some of the regulation developing, the question is what's going to happen from here, right? Because as you get more of the traditional finance players and some non-banks even, right, like the likes of Amazon, Walmart, the question then is what does that landscape look like? And so innovation will happen where there's good returns and where there is to be made, right? I like that it is getting more mainstream adoption. Don't know that it will continue developing in the way that it has before. So sort of let's see what everybody's going to do at this point. But I think one thing's inescapable, which is that this technology, it definitely represents an upgrade from some of the existing payment systems that we have today.
So you brought up regulation. Maybe that's a good segue into the Genius Act. So do you want to explain what the Genius Act is, what the implications are for stablecoins and insurance?
So the Genius Act is a piece of legislation that focuses on, very narrowly actually, on stablecoins. And what it allows a U.S. entity to do is, whether it's a bank or a non-bank, by the way, I think this is where the Genius Act is a little different than its European or Japanese counterparts, that it allows any entity to develop a stablecoin as long as it's backed by fiat reserves 1-to-1, so they need actual US dollars sitting in an account, as long as they follow some regulations around consumer protection, submit to the requests of federal or state regulators. Some details there around whether you need to be regulated by the state or by the federal government, depending on your size, but broadly speaking, is what I would say innovation-friendly bill that opens the door for virtually any company that wants to explore using stablecoins as a payment system or as a store of value, right? And I think about how they're essentially digital representations of US dollars. So they don't have the volatility that Bitcoin has, right? That stablecoin is always going to be equivalent to $1 US. And the fact that it's essentially pegged and the fact that it's regulated today would allow just a lot of applications where the world of banking and the world of consumer financing or even just systems, I think it opens the door for more companies to leverage this technology and increase the volume of supply of stablecoins, right? And that day, actually, it's about 1% of the entire US money supply. We're really talking about a lot of growth ahead of us here.
So just to clarify, did they have to back 1-to-1 with fiat, or is it also treasuries? I thought they could do certain mixes of treasuries as well on the stable coins.
I read was fiat, but I would suspect cash and cash equivalents would probably satisfy that, right? It just has to be liquid and it can't be risky. Because there are flavors of stable coins that will actually allow risky assets. But this legislation specifically does not comment on that. It just says if you want to start a stable coin, your stable coin has to be fiat backed.
Okay. And then I guess what I don't quite get, and you got to persuade me on this, when I go into my bank's app and I see the dollars in the account, right? That's essentially a stable coin, right? Even though it's like represented by a US dollar backed by the government, it's essentially a digital representation of that, which in itself is a stable coin. And for like domestic consumer level business, it almost acts exactly, if I'm using my debit card, right? It acts exactly like a stable coin. And I understood the benefit of stable coins kind of in the previous iteration before the Genius Act, where it was like, what Meta was trying to do, like several years back, right? A basket of currencies. So if I'm in a third world country, I can essentially use that as a currency. It's much more stable than my local currency. And, it's like attached to my Facebook account, even though I don't have like a local bank or something. I think the trust that this brings to the companies backing the stable coins to the Genius Act, that's good, right? Because there was always some sketchy stuff with Tether. I also wonder, like, for the folks who are just trying to be outside of the purview of like government oversight into like my transactions, right? I want privacy on these. Didn't we just kind of come full circle to like the dollars in my bank account? Can you differentiate it for me from like why this is different outside of like large transactions across the globe that aren't bound by the SWIFT payment system?
It really comes back to, do you know where your money is that your bank tells you? If your bank says you've got $100,000, do you actually know where that is, right? You said it's a virtual representation of the money that you've given to the bank. All the bank is telling you is, here is the total value of what you've already deposited into my organization. Do you know where that money is? There's a good chance the answer is no. And everybody knows, right? The bank is using that money for other productive activities. They're lending it out, or they're at minimum getting a yield on it, so it's not just sitting there. Some of you might remember that SVB, Silicon Valley Bank, collapsed in 2023. Right? It's a fairly simple reason why. Essentially, a liquidity crunch. People wanted money, and they had to liquidate their assets at a much lower price than they bought them for. So that was a vicious cycle, which led to more liquidation, yada, yada. Eventually, they had to shut down in 2 days. I would argue if you were banking with SVB, you would also see the same balance. They would have told you, yes, you have 100,000 with me. 2 days later, you would still see the same balance, except you don't actually have your money, right? I think that's the difference with having a ledger that is just to anyone to be able to verify where are those assets sitting and what is it doing, right? That's the key difference. So if you were to say, deposit your money with a bank, I think the challenge is that your bank itself may not have the money when you want it, right? And so that depository institution is there's insurance on that. The FDIC protects your money, but the true security is you actually holding on to your money and you know where it is at all times, right? So that's one key difference.
Yeah, that makes a lot of sense to me. And I do wonder what the macro implications would be, because like all of money creation is essentially based on this fractional reserve banking. And then if we move that to stablecoins, which have to reserve 1-to-1, what does that mean? I almost wonder if we create the monster that we were trying to get away from, where then the government just has like a monopoly on money creation.
I would say to that is the reason banks do that is also to ensure that they are being productive with their money, right? Not just hoarding all this cash and putting it in a vault because the inflation is going to erode the value of that. All we're saying with this digital representation, right, with stablecoins, is that you actually take control of that decision yourself. You want to keep your money in your wallet under your pillow, you have every right to do that. And then you'll watch that money erode in value over time, right? With inflation. Talk about decentralized finance. There are applications out there that will essentially allow you to mimic what banks can do, right? You can participate in exchanges, you can participate in lending protocols. You are able to make decisions on how your money works for you and how your money is productive in the similar ways that banks can, right? And I think that's another big key difference here, is that as consumers banking with depository institutions, typically absent trading, okay, because that's a different kind of financial activity. Typically, I think your only options were high yield savings accounts or put your money in, it doesn't earn anything. And on top of that, you have to pay fees just to keep the account open. That is not the case with DeFi. You just have access to a lot more options of how you want your money to work for you.
Going into the fee, just one last double click. The part about fees, I feel like is maybe more complex than we paint it, because, like the fees are just kind of moving towards you're taking on some risk and some maintenance, right? And then also the cost of the transaction is tied to the system's ability to like service those. Like when you were mentioning like credit card fees, right? Part of that fee is the backing of like protection against fraud, which makes up a substantial amount of the cost of like credit card transactions. And so like if someone steals my card, even if it's online or physically, right, that is going to be protected. I won't have to pay the cost of that. But if someone steals my phone with, these measures, right, and they spend all my money, there's no backing. And to some degree, you might say, well, that actually it gives you an incentive to kind of protect yourself, and it will just reduce the total cost of the system. But at the same time, are people really ready to move there? So I just like wonder if the fee argument is totally like representative, like one-to-one, like what the opportunity cost is.
That protection that you described is very specific to credit cards, right? If somebody gets your debit card, essentially it's the same outcome, right? As them
that's a good point.
They have your 12 secret words to your wallet. It's the same thing, right? You're going to lose all your money, or worse, you just forget the 12 secret words and nobody actually stole your money. You just can't spend it. And so that's unique to credit cards, right? And I think that's just a function of what Visa and Master and any other in that space decides what they want to do going forward. I don't see necessarily a whole eradication of the credit card system, because I think there's still some value there, and I know they've built themselves quite a bit of a competitive stronghold, right? Technology, just because it's cheaper and quicker, is not going to make them delete overnight. So I do think they'll adapt, right? The consumer protection you're talking about, I think that will come over time, right? To your point, because what we're seeing today is there are ways that you can pay. They're actually a bit more challenging to get, because you have to go through a credit check and whatnot. So there's already that level of exclusion for me able to enjoy those protections. Those kind of protections, to the extent that we can see participants in the DeFi space trying to develop those same consumer options, that's just all potential. And I don't see why we couldn't have that in the future. We're not there yet, but it's not to say that it won't happen.
If you could say boil it down to one sentence, what problem are you trying to solve at Re?
Trying to take the balance sheet structure, add a layer of innovation to it that I think has not been done in a long time. And what that will allow anyone in the world to do, again, with that connection, is participate in the operations and the financial performance of a reinsurer. Historically, now this is beyond the sentence, but
No problem.
Yeah, you get more than a sentence now. You can dig in.
Historically, if you wanted to start a reinsurance company or be an investor in a reinsurance company, you'd have to go through private equity or venture capital. Generally speaking, the average consumer is not able to access those avenues of investments. So you'd have to wait until the reinsurer would achieve some level of maturity, decided to go public. And once they go public, and assuming you can access the stock market, that was the only way you could do it. There are all these other innovations within the insurance space with cat bonds, sidecars, that again are only limited to very few privileged individuals. So what we are doing is we're opening that up. We're saying, as long as you have a internet connection and a wallet with some assets, and you wanted to participate in the financial performance of a reinsurance operation, that is now an option that's available to you.
Can you you explained it to me once on LinkedIn how it works? Because I was thinking you would just collateralize a bunch of risks and then put a token for that and just put that out there and let it trade. But you were saying that it was a different structure.
Essentially, what happens behind the scenes is, so let's say, Max, you have some stablecoins and you're tired of those stablecoins not returning you anything. You decided you wanted to put some of the stable coins to work. If you deposit $1,000 with Re, we do is we give you a token representing the $1,000 that you've contributed. So you get $1,000 worth of tokens. And those tokens allow you to participate in whatever profit the reinsurance entity is producing. And so that will be a combination of the underwriting performance, which is basically just our combined ratio, as well as the investment yield on the float and the capital that you've provided. So it's not unlike taking your money, going to private equity and saying, I want to have a 1% share in this new insurance startup. Now, the key difference, though, is yes, you still get right to any remaining profits, right, after all the liabilities have been settled. Key difference, though, is that token of ownership that you have, you go through private equity, it's not transferable. You can't do anything. I mean, you can sell it, but it's a very illiquid secondary market. You also have to find someone who is willing to buy it from you. There's no marketplace for that generally. Because we've built our technology within the DeFi space, it's sitting now on a lot of other applications that can talk to each other. And one of those applications is an exchange. So we can take the token that we've issued to you. You can then go to an exchange and you can exchange that for another stable coin or a different asset entirely, as long as, of course, there's liquidity in that exchange pool. That gives you, that's essentially a secondary market, right? That gives you an additional layer of liquidity that does not exist today. So it's allowing anybody to plug into a reinsurance operation, but then also allowing them to take that token and use it within the DeFi ecosystem. That's what we call composability, which is you get to have an application with all the other applications in the DeFi space. So you're not just building something in isolation, you're building something that can tap into the broader ecosystem. So for example, if you wanted to, some folks want to trade on leverage, right? Let's say you really believed in Re as a vehicle to generate growth. You wanted to leverage 5-to-1 against whatever your assets were. You can go to a lending protocol, you can borrow money, and you can take that and deposit it with us as stable coins, right? That would give you is access to our returns, but because you've now done it through leverage, you get even more returns. The whole ecosystem is built to kind of all operate seamlessly with one another. That's the additional level of access and advantage that you get from doing this.
Are these live right now?
It's a little different if you're in the US versus not, because the stablecoin regulation is fairly recent. But if you go to our website today, there's actually wallet addresses that you can go in and look, because I mentioned earlier, all of this is transparent, right? This is all public information. You can actually look at how much has been deposited. There's actually information out there that will tell you the premiums, the losses that we've paid. And this is actually another huge advantage of the fact of how we've built this. As a cedent, if you buy reinsurance from us, you don't have to rely on us telling you our level of capitalization to feel like, do we have enough money? Are we able to stick around? All that information's in there online. You can determine your own actuarial estimate of what you think our capitalization is. So that information is there 24/7. You don't have to rely on the rating agency or us to tell you, yes, we're fully capitalized or more than adequately capitalized.
That's really interesting, actually. Maybe for the counter argument against what I was asking too, like why? Because like there are these companies that they issue a bunch of mortgages, they securitize it, they put it into something not called a CDO anymore, but it's essentially a CDO, and then that trades on an exchange. Why is the approach where they're taking a stake in your performance better than that type of you securitize a whole bunch of risks and kind of like issue that kind of like an insurance linked security? Why did you go the route that you went instead of that way?
So during my time working at a reinsurance brokerage, I helped build the marketplace for mortgage reinsurance, and a huge part of that marketplace was Fannie Mae and Freddie Mac buying protection essentially for the credit risk in their portfolio. Interesting because there's a lot of these parties involved, right? The trust needs to be set up. Somebody needs to make sure that the trust documents are followed. There's a lot of fees associated with that. And then on top of that, you've got this really massive legal contract, 400 pages long for every single deal. And there's like 20 of these deals a year. This was before ChatGPT, so I really wonder who actually spent their time reading them. In order to get one of those done, there's just so many people involved, so much cost involved. And at the end of the day, all that and look at it, it makes a lot of sense if you have a lot of volume. That kind of financial engineering, I would say, is generally available only to the largest banks, right? If you wanted to do something like that and you were a local community bank, I don't think that's available to you, right? So that's one. That, all of those characteristics I described were actually really solved or alleviated by the technology, right, presented by DeFi, which is you don't have to trust that bank A or bank B or bank C is doing the right thing because all the data is just recorded and anybody can go and look at that data, right? All of that is on top of the data, all the payments, all the flows of money is governed by smart contracts, right? So historically, the bank would get the principal and interest payment, and then they'll have to divvy that out between what goes to what tranche, and somebody else has to figure out, which investors are getting paid what. Smart contract takes care of all of that, right? So you don't have this level of legal risk where you're having to figure out, are people incentivized the right way to behave according to the investor's interest? That's the other thing about having contracts sit behind all of this is all basically auditable. It's code that is written basically in English that can be audited and can be very easily verified by anyone. And if you can see what it's doing, you can understand exactly how your money is going to behave, right? Again, the whole point of this is you don't have to trust anyone. It's information that you can verify for yourself. I think that's the foundation of what we're trying to build. So when you say, why don't we go through that route? Why do we go through this digital route? I think we're basically doing that route that you're describing, but in a digital fashion. Right, without all the lawyers and the 400-page contracts and the different trust keys involved with the different guarantors involved and whatnot. And we're doing it in a way that is composable and trustless and very easy to verify.
So we talked about a lot of cutting edge technologies, but where do you think we're going to be, say, 5 years from now? What's going to be going on in reinsurance?
Where are we going to be in 5 years?
Quantum reinsurance, is that coming?
Not really sure what that is. I would be excited to see what that actually is. Quantum computing, I'm excited about. I think it will represent a new frontier in what we're able to accomplish with the raw computing power that we have. But in terms of the insurance industry 5 years from now, 5 years is actually kind of a short amount of time in an insurance cycle, isn't it? But the challenge, I think, with the last wave of insurtechs, it started kind of in the mid-2010s, is that financial incentives now apparent to anybody who wants to start an insurtech. They're going to look at folks that went public and even some of the folks that did not, and they're going to say there's some challenges associated with that, right? And I think what that's going to do is going to require that insurtechs or any new insurance entities that are forward are going to develop focus. Can't be everything to everyone. You have to do a few things right and really well, better than the incumbents in order to gain any kind of adoption in the space. What I mean by that is there are some early insurtechs that started SMGAs and then wanted to be carriers and they wanted to own the entire supply chain. They wanted to do claims and distribution and underwriting and pricing. And some of them went public, and I'm not going to name names, but I think it's very easy to tell that not all of them are doing well. I think there's still a market of untapped potential here because it's a growing E&S space. There is technology there that I believe could be deployed better, and because it's E&S, can be done in a more agile manner. What I'm hoping is we continue to see more entrants into the space. Not necessarily new insurtech carriers want to dethrone incumbents, but more services, right, that help with distribution, writing, frankly help with fraud, with some of the prevention I was talking about earlier. Love to see more of that come into the space and make a use case it can actually fit from an economic standpoint, fit into an insurer's operations, right? So show the insurer that they can actually save money, even though it costs a lot up front, and be able to be either embedded or be neutralized into the ecosystem, right? I think that's been a challenge for any tech operator that wants to come in now, that there are insurance companies that are either hesitant or looking at the economics and saying that's not going to work. My hope is that continues to change in a manner that you can see broader tech adoption.
Funny, this question we have actually ties into something I wanted to ask you about because of your LinkedIn profile. So I was looking at your LinkedIn, your prior role you had, and you had credited one of your accomplishments to a bunch of complex analytics and a smidgen of actuarial charm. And I just love that because we're always thinking about the tech skills, but maybe forget about some of that, the human actuarial judgment and the communication and the influence. So I love that you had called it out that way. But our question for you was, will we see fully on-chain insurance, or will human judgment always have the final say, or that actuarial charm?
Insurance fundamentally is economic activity that's capped on the upside and very much almost unlimited on the downside. Right? So what I mean by that is insurance companies, if they get it right, the maximum amount of money they ever make is their premium. If they get it wrong, they're going to have to pay a whole bunch of claims and a whole bunch of money. A very asymmetrical change, right? Typically, if you're an investor, you have a lot of upside and you only lose as much money as you put in. It's not the case for insurance companies. And so the reason I describe it that way is because the stakes for insurance companies to get it right are a lot higher. The financial services side, I think of it as robo-advisors, right? I actually used to invest some money with Better, a company that used models to automatically allocate your money for you, right? So it's sort of like you don't have to do the thinking. It'll just decide what investments made sense. You gave it some parameters about how risky you were as an investor. The upside there for me is it makes a lot of these great investment decisions. I make a lot of money. I can retire early. Downside for me is, I've lost all the money I've put in, right? But if I were to start an insurance company, personally, there is no way I'm going to give the keys to an AI. There are some insurance companies out there, or reinsurance entities out there, ironically enough, their time, let's say in the last 20 years, they probably would have been better off financially if they didn't write any business at all. I think that speaks to the kind of trade-off, right, that you're making here. And so you always want a human in the loop. Anytime your downside is so much worse than your upside, having to decide how to make economic and productive use of the capital that you have. And for me, I think the human in the loop is always going to be crucial in the insurance space. And so, mention, is insurance going to be on chain? Yes, it's going to be on chain in the sense that there are elements of the insurance transaction that can be, verifiable without having to work through like a claims adjuster or whatnot. I think what you're more leaning toward is there ever going to be a fully autonomous insurance company? And I think the answer is no. Stakes are just too high. And I'm happy to eat my words on that. I hope to see that in one day. Maybe I'll take a contrarian bet against it.
Nice.
but I personally, where I think, not that I don't think the technology is good. And I think the technology is great. Just don't trust that if it's not a human making that decision, and it's not a human owning the consequences of what happens if the decision goes wrong.
I'm going to commit some serious insurance fraud against the first fully automated insurer. So I'm calling it out now. So hopefully they build that into the system, not to write me, but it just seems like going to be ripe with fraud. So yeah, Jonathan, this has been an amazing presentation. I mean, It's always fun to talk about internet money. So I think there's a lot of new information for people here. It will be kind of interesting to see if this is kind of the seed that allows the industry to flourish on top of this. I wonder if you wouldn't mind sticking around for the lightning round where we just go rapid fire, get some quick thoughts from you. So you've talked about a lot of things that you are interested and excited about, flying cars in particular. That does sound pretty cool. What's one thing that makes you roll your eyes, particularly in insurance?
I see a lot of posts on social media now where it feels like the claims adjusting process has gone on TikTok. And I just question, and some of that is just people are unhappy, right? So they go to TikTok to vent their frustrations, but they're like, look at what happened to my property. Why is the insurance company telling me it didn't happen? Or why am I getting denied a payment? The social media has brought some interesting to how insurance is transacted.
Next question. This is one we ask all of our guests. Is there a book or a podcast that you've loved recently, insurance or otherwise?
It's a tough one. I listened to a few, but I don't know if that's what it's called. No, but the folks who did Freakonomics, it's always on the radio in the background, so it's always just great to listen to. It just touches on a lot of random topics, interesting stuff that nobody really thinks about. Puts a lot of spotlights on something interesting. Listen to a few science ones as well that talk about the launch of the JWST, the James Webb Space Telescope, and so there's been a lot of interesting findings. Some of them challenge this notion of is the Hubble crisis in cosmology? Is the Hubble constant truly what we think it is? If you measure it one way, you get this number. If you measure it another way, you get another number. And the implication of that is the universe as old as we think it is? Human life is really short in the span of the universe, right? You think about, I've got 2 kids. One of them is going to be Gen Beta. That's crazy to think about. Think about, what kind of world they're going to grow up in. Because I went from modem to cell phone to, not having to check your movie times in the newspaper in a very short amount of time, right? My first kid is always on his iPad now. So what kind of world they're going to grow up in and inherit is something I think about a lot. The technological advancement is mind-boggling. I think makes it to the consumer stage is really like in 15 years after it's already been developed. So I think a lot about what's actually available today that we can do, and what that means for somebody who lives to 2100.
All right, last question. You fast forward insurance 10 years. What's the one thing that you want to see that's been changed since now? Otherwise, you do the Thanos snap. You're just so angry it doesn't exist. You burn it all down.
I'd like to see insurance evolve to become eventually a real-time signal of risk, right? I think I mentioned it earlier. People make decisions in their daily lives. Some of them are productive, some of them are not as productive. And I'm not inclined to say insurance companies should be the arbiter of what everybody does in their personal lives, but I think some of the decisions should be made with the best information available, and insurance companies are unique owners of that information, right? Because not everybody is going to go through the same consequences in their lives, where if you drive recklessly, that part's obvious. If you drive recklessly, you're going to likely end up in an accident, right? But there are other decisions that are not as obvious. Insurance companies, like I said, they have that data, right? Again, written in loss ratios. So depending on who you're buying from, I imagine if we still have a fragmented insurance market in the future, you're going to get different signals, right? If you buy from this one company and if you decide to speed, might see a different kind of warning than another company. So my hope is that companies can come together and take that information and create something that gives consumers, businesses, a signal for how to improve their risk profile, how to make better decisions. That would necessarily require opening up data, to a broader population. So it hasn't happened in the past. I wonder if it'll happen in the future, but that's my hope.
Well, amazing episode. I mean, it's been great talking to you. You're really forward thinking, which I've been told I'm very forward thinking, which usually feels like a backhanded comment to say slow down. But you seem very calm, and you're not getting as much frustration as I am. So I really appreciate talking to you. Hope to get you on in the future.
Yeah, thanks so much, Jonathan. Thank you, everybody, for joining us for this episode. And just a reminder, if you have thoughts, we want to hear from you. Let us know what you're thinking about tech adoption, about stablecoins and insurance, what the future of reinsurance should look like. Just drop us a note anytime at podcast@cas.org or comment on LinkedIn. Be sure to like, follow, and share Almost Nowhere wherever you listen. Thanks again. We'll see you next week.
The views and opinions expressed by the hosts and guests on this podcast are their own and do not necessarily reflect the official position of the Casualty Actuarial Society, its subsidiaries, or the employers of the hosts and guests. This podcast may discuss topics related to insurance and regulatory issues, but the information shared should not be considered as legal or regulatory advice.